For the first time in history, oil prices went negative. Unfortunately, it does not mean that you can go to Chevron, fill up your tank, and ask the cashier for 20 bucks and say, have a good day. But sellers are in fact paying buyers to take oil off their hands. And here's why. When COVID-19 caused worldwide shutdown, there are no planes flying, there are no cars driving anymore, and the world is burning a lot less oil. So when there's no demand, the supply would usually come down to a balance point so prices don't collapse. However, coincidence or not, Saudi and Russia decided to get into a price war in order to fight for market share. They're flooding the entire market with excess supply of oil, and that pushed oil prices down to the low 20s. Now the world is completely running out of storage for oil. You might be wondering how you can make some money off of this. It's simple, right? Buy oil at -20 now and sell it later for 50. Well, to really get what's going on, you have to understand how crude oil is traded. Usually for stocks, say Amazon, you can buy one share and essentially hold it forever. But for commodities like coffee beans and sugar and gold, they're traded in futures contracts almost 24/7. For crude oil, each contract is 1,000 barrels and each barrel is 42 gallons. Typically, there is a contract for every month. So why can't you buy some oil today and sell it later? Well, you can, but it's not really feasible. If you buy one futures contract that settles in April and still hold it past the settlement date, which is today, you would literally have to take 1,000 barrels home from Cushing, Oklahoma. If you got the facility for storage, yeah, it's a once-in-a-lifetime opportunity, but more than 90% of futures traders have no intention or means to take physical delivery. And that's why everyone was trying to sell their position today, no matter at what price. What we had today was a paper oil trading liquidation problem, where buyers were all rushing through a very narrow exit to get out of positions. So can you buy and hold later contracts? Yeah, but each contract after today is at a different price. June contract is at around 21, July contract is at around 27, and if you fast forward to June of next year, the price is actually almost 36. You will have missed most of the gains already if you hold a much later contract. So here's why you can't really easily take advantage of oil prices rebounding. If, let's say, you buy a June contract for $21 today, you either have to take 1,000 barrels home on June 1st, or you have to sell it at whatever price it is before the settlement date of May 19th. It might be 25, it might be 0, or it might be -40. Then, if you want to switch to the July contract, you'll be paying the new price again of, let's say, $27 and start all over again. So when this later contract costs more than the current contract, this is called Contango or forwardation. Now, what about those commodity price tracking ETFs like USO or UCO? USO is around $4 right now, and yes, they're supposed to track the underlying crude oil price, but you're essentially paying a management company to do exactly what I just mentioned. They take yours and everyone's $4, and they buy the front month futures contract. So when the settlement date comes, they have to sell their current month position and roll it into the next month. The issue with holding these ETFs long term is that Contango will eat into your returns. A simple test is if you overlay the crude oil price on top of the USO chart for the past 14 years the ETF has been around, you will see significant underperformance. Now, what about those oil company stocks? See, the cost to produce a barrel of oil between different locations is very different. In Middle East, you could punch a hole in the floor and you might see oil gushing out. The general cost there is around $8 to $10 to produce a barrel. Now, in the US, oil companies have to build platforms above oceans, they have to drill miles and miles down. The cost is much higher at an average of $30. So if oil prices stay below 30 for an extended period of time, a lot of US oil companies will actually go bankrupt, while the Saudis still have a couple bucks to bite off. So investing in US oil companies is actually risky because you're betting not only on the oil price rebounding, but also on the financials of the companies themselves. So what does that mean, right? Just as a quick disclaimer, I'm not holding any positions at this moment, but my recommendation would be to stay away from trading futures unless you've gotten a complete understanding of the complex rules of these contract settlement and contract rolling. And remember, it's actually highly leveraged. Each contract typically represents tens of thousands of dollars. I would also stay away from commodity price tracking ETFs like USO, unless you're in just for a quick trade for a couple of days. Otherwise, mucho Contango. What I would recommend doing is doing some analysis on oil companies with strong financials that will most likely have the ability to kind of weather the storm. Now, you can also take a look at airlines and cruise lines, but some of them will default. And you might end up essentially betting on which companies are going to be bailed out by the government.